Okay, so let's recap the macro situation. Today, the G7, or the Western world, finds itself in a situation that a lot of people are calling the debt supercycle. This is essentially where, after a financial crisis, private sector debts were assumed by the public sector and now reside on the public sector balance sheet that are now being financed by central banks. Essentially, it's sort of rolling the snowball of debt from private sector all the way through to fiat. One of the very interesting things about Japan is that Japan had its financial crisis 16 years before the 2008 financial crisis. And Japan, being the world's third largest economy after the US and China, also has the world's highest debt to GDP ratio. Japan's debt to GDP ratio today resides at about 265%, which is nearly twice as big as the second most indebted country, which is Italy, at around 140%. So it's way more advanced on this trajectory than the rest of the Western world. Why is that bad? Well, today, Japan's tax revenue is about 13.5% of GDP. With a debt to GDP ratio of 265%, that means that if the on-balance sheet interest rate, or the interest rate that the government actually had to pay, were only 5%, 100% of tax revenue would need to go towards paying interest alone. That means there's no money for pensions, no money for welfare, no money for military, which is a growing risk, no money for regular public services. That's essentially what Kyle Bass calls the Keynesian endpoint. And it's just sort of the terminal end of this situation. Traditionally, countries try to fix this problem via two paths. The first one is to grow GDP. If you grow GDP, then the debt to GDP ratio diminishes because of a larger denominator, but also you have more tax revenue because you have a growing economy. The second situation is the more controversial one, which is debt monetization. So I think it's really important for us to visit how did Japan get in this situation from a brief perspective. Japan was a really fast-growing economy, and it grew so fast that it ended up becoming a bubble. Essentially, they called it the bubble economy, where asset prices just inflated extremely high, and people would say that at its peak, the value of the land underneath the emperor was worth more than all California real estate combined. Just to give you an idea of the magnitude, I don't know if that's totally true, but just to give you an idea. Well, in the early 90s, that bubble burst. And what happened is, when a bubble like that bursts, consumers and the economy itself go from a net positive asset balance sheet to a negative asset balance sheet. So what that means is that people are not able to sell their assets to extinguish their debts. They sell their assets, but it's not enough, and so there's still debt outstanding. The consequence of that is that demand gets stripped out of the economy because people spend their discretionary income paying down debt instead of helping grow the economy by buying goods and services. Producers, on the other hand, will hold their output constant, theoretically, in order to try to grow their way out, and so it causes a deflationary cycle. As demand drops but supply stays constant, price needs to drop in order to meet supply and demand. The natural response from the Central Bank of Japan, the BOJ, was to cut rates down to zero. Essentially, the BOJ was the first mover in terms of cutting rates down to zero. The idea here is to lighten up the debt burden. This wasn't enough to spark growth and fix the situation, however, so the BOJ started to improvise. The BOJ is actually the central bank that invented QE. They invented it and launched it in 2001, and their idea was to try to stimulate the economy beyond just cutting interest rates by doing quantitative easing. Unfortunately, that didn't work either. But there was a secondary effect that did happen from all that central bank activity, and that is that it lowered the cost of government borrowing. And it allowed the central government to continue to issue more debt, trying to spark the economy themselves, grow their budgets, grow deficits, and essentially layer on a higher debt to GDP at a lower cost because the cost of debt was essentially nothing. Okay, there's an interesting aspect here from having lower interest rates in Japan than the rest of the world. and that's the yen carry differential. The interest rate differential between the yen versus the rest of the world became that it was cheap to borrow yen to buy higher yielding assets or higher yielding foreign assets and foreign currencies. They call this the carry trade, or the yen being a funding currency. Now, this actually didn't really destroy the value of the yen as many people think it would, because there's still a lot of external demand for Japanese goods, and Japan was a net exporter of goods, which created buying pressure or international trade bid for yen. And so in consequence of that, the Bank of Japan was able to amass one of the largest FX reserves globally. Essentially, today the Japanese FX reserves currently lie at about $1.2 trillion. There's another aspect that continued to prop up the value of the yen as well. Not only was the yen a net exporter, but globalization, which helps support net exports, also decreased the cost of production worldwide, which is a deflationary event. And so post 1970s inflation and really peaking in the early 80s, we have had 40 years of a bond bull market, which essentially means that there's a global convergence of rates falling down to Japanese levels. So the yen differential has been collapsing and converging for essentially the past 30 years now. This brings us to the Great Financial Crisis. The Great Financial of 2008 essentially had the same response in the US and elsewhere in the world that we saw previously in Japan. Central banks cut rates down to essentially zero and started experimenting with quantitative easing. Post-Great Financial Crisis and central bank activity, the yen rallied pretty strongly from 2008 all the way to 2012. Now, despite this demand for yen, something else is interesting. The Japanese economy didn't recover as strongly as, say, the United States economy and some of the other Western countries. And a lot of that is due to structural reasons. This brings us to the election of Shinzo Abe. Abe ran on the platform of Abenomics. Essentially, it was a three-pronged solution to try to restart the economy of Japan and fix some of these structural problems. The first solution was to double down on monetary policy. The second solution was to increase fiscal spending, offset by some tax hikes. And the third solution, or the third arrow, was to do structural reforms such as joining the TPP. Those effects didn't work well enough to spark the economy again, but it did devalue the yen a lot. The yen lost a lot of its value as monetary policy went to negative interest rates, more QE, and in 2016 introduced a policy of yield curve control, which is essentially a way to get yields down across the yield curve as opposed to just the front end. Now the interest rate differential was once again really big. So now, where are we today? Despite the massive moves in Abenomics and the subsequent devaluation of the yen, almost nothing compares to the COVID-19 crisis. In response to the COVID-19 crisis, we had two reactions. Global monetary policy around the world essentially doubling down, where central banks' balance sheets essentially grew by 100% from an already extremely historically large level. And two, the effects on the supply chain caused global supply of goods to diminish by drastic amounts. Remember earlier when we talked about post-asset bubble burst, that demand was diverted away, but supply remained constant? The response to COVID is the exact opposite. Monetary policy and fiscal stimulus help continue to drive demand higher, while supply chain shocks reduced supply simultaneously. So this created a spark of inflation that we haven't seen for decades. Can Japan really continue to be an island of low interest rates when the rest of the world is raising interest rates in order to combat inflation without having a break in the yen?